Hi, everybody. This is Seth Martin, and welcome to the Middle Class Investor. Well, we're looking at a chart of the S&P 500 and had it on a week. I guess I switched it to a day. But as you can see, we've had now 4 weeks in a row, pretty strong up moves with some either gap down or gap up in the mornings. We had this big hammer right here, which kind of marked the reversal. A couple of you wanted to know, is there enough time for me to get back into my 401k? And I'll be honest with you, back here at this time, I wasn't sure whether there would be enough time. Ideally, you'd get in, once you closed above there. Now in a 401k, you'd get in. Right up here where the close of this is. That's where your 401k would actually get in. So the concern, is one, I didn't know we were going to have 4 up weeks in a row. I mean, there's no way to know. And so, this could have, what if this had just gone up a couple of weeks and then rolled over and went down? So I wasn't sure there would be enough time here. A lot of you have 401ks and you have restrictions on how often you can get in and out of your 401k. So anyway, that's just a piece of information there. Now, as far as last week, I went to Dallas, and I was so busy up there, just didn't have time to do a video. My grandmother has been in a car wreck and she's hurt pretty severely, so it was just busy with family stuff. But I'm back this week, and by the way, I think she's going to be okay, but she is, 89 years old, and she did have a lot of broken bones and things that were happening in the wreck that aren't good. So I'm hoping and praying for the best, and she looked pretty good the other day when I saw her. So I'm hoping that trend continues. So anyway, we've talked about the trend at this point appears to be to the downside. And let's just recap why we said that. We had some highs back here where this is actually the high. And then we've had, it pulled back, rallied to a lower high, pulled back even further, rallied to a lower high, pulled back even further, and so far has rallied to a lower high. So we've got a downtrend, and I've marked the important trend line here, although this other one is important too. If I connect the high with that high right there and extend it out. So we should expect the market to reverse somewhere in between these two trend lines. So what does that mean? That means we could have another week or two to the upside. So this is taking a little longer. I think a logical place, let me zoom in a little bit. You can see on my right here, I've got a gap that I've had on here for a while. Right in that area right there. And the market tends to want to go to a gap and fill it before it turns and goes the other direction. So I think this is a good logical place to expect the market to go to. Now, what it could do, just to prepare you, it could, at the end of the week, it could look like something like this. So that, let's say it opened here, the bulls ran it all the way up here, but then the bears pushed it all the way back down here and closed it. And this is very similar to a hammer that happens at the bottom of a downtrend. So you have a downtrend, and this is a hammer up here. This is called I think it's called a hanging man or a tombstone doji. I'm not sure which one it's called. Doesn't matter what it's called. The point is, it's the opposite of this one. It happens in an uptrend. You basically exhaust the buyers, sellers take over and start pushing it down. So if that happens, then, and I am saying if, because, I mean, it is possible, although unlikely, I think, at this point, this could go up and make a new high. I mean, it could eclipse this high. But I think the more likely scenario is that we run up here, fill the gap, and then the market rolls over and starts coming down. And this sell-off, the second, so I've talked about this before, the second time down. So let me just zoom. Let me do this. So this would be the first time down right here, okay? And this would be the correction back up, okay? And then the third move, the next move down is usually fairly substantial. Now, what do I mean by fairly substantial? That sounds kind of cryptic and vague. Well, if we extend out here, let me take this Fibonacci off, since we've already talked about the gap, but we can just use Leonardo da Fibonacci to kind of make an estimate. We can do an extension from low to high, and this move is going to probably be down here between 14 and 1300 or so, somewhere in this zone right here. We can put an oval there, and that should happen relatively fast. I mean, you should see that happen over the course of a few months, 2 to 3 months at the most, maybe a month and a half to 2 months. So this is why it's so important to identify the trend as early as you can, because if you get caught up in experiencing this, you're gonna well, let's see how far back. Let's just say it goes all the way to this 13, 14 area. That takes you back to the 2012 lows. So that's pretty hard to swallow, lose your 4 years worth of gains. I mean, you just don't want to give all this back. There's a saying that the market takes, it takes the stairs up and the elevator down. So, these moves here can be pretty dramatic. So now let's talk about, the best way to handle it. It all depends on how much risk you want to take. That's why I've been talking about, the risk reward to the upside. Is it really makes sense to make, I think in here I was talking about, does it really make sense to hang in here for an extra 2 or 3% when the downside is 10, 12%? And you have to kind of look at it the same way here. The gap is likely to fill. That's likely to be where it turns. Maybe that's where you step aside. Maybe you wait for confirmation. The more confirmation you need to make a decision, the more risk you take. So some of you might want, maybe your confirmation looks like, let's do a couple different scenarios. The reason I'm spending so much time on this is because this is what you're going to be facing in the near term. So let's say that you're looking at this, okay? So you've seen it run up, you're still in, and now you got a candle like this. And let's say these are weekly bars, or you could shorten the distance and use daily bars. But you might want to wait for 2 bars to close below the high. But let's say you did this and you said, okay, I'm going to step to the sideline right here. Okay. So on that day, if it looks like it's going to close below this low, then I'm just going to go ahead and step aside. Well, clearly your risk, and I'm going to show you, your opportunity cost is maybe to here, 2150 or so. Okay, because that would be the decision point area would be somewhere right above this high. So I don't know if I'm making that clear or not. So the upside, the part that you're potentially leaving on the table, would be in this zone here, and then the part that you're potentially avoiding would be down here in this zone down here. Okay, so risk reward is about equal. Okay. Now, let me zoom out and zoom back into a different place. Let's say that you need confirmation. You don't want to get out until we break this low. So let's say you got out right here. Well, now what's your risk? Your opportunity cost is still up here. So I got to zoom out again to go see that. It's still way up here. Sorry, I'm having some technical difficulty. Your opportunity cost is still way up here. And you've in other words, if you're wrong and the market turns and goes back up, you're gonna miss more to the upside. But you should save yourself from the downside. So it's just, bottom line is you have to pick a place for yourself that you're comfortable with and that you're okay with. That you're going to be okay if you lose money or make money based on that decision. Now, I will tell you, once you break this low here, this is something to think about. Once we break this low, the candle is going to get really big. I mean, it's going to look, I know you can't even see that, but it's going to be a candle. It'll probably be a candle like this one. So let's say you make your decision here. Well, at the end of the week, I mean, you're already down 6 or 8%. So that's one of the bad things about waiting until you get down here is once the decision, I mean, you can just see it here. Again, I'm spending a lot of time on this because this is where the rubber meets the road. You can see it here that we went up, made a high, and then we sold off and then retested. So you had a lot of opportunity to get out, but if you kind of piddle around, you can see here all of a sudden the candles got really big and the market dropped really fast. So that's the downside of waiting for more confirmation. You start getting into the meat of the trend. The middle of the trend is the meat of the trend, and so the longer you wait, the more you're going to lose, the more risk you take. All right, so last time I spoke, we talked about the fact that volatility wasn't likely to go much lower, and as you can see, it really hasn't. It really hasn't gone much lower. It finished this week above last week's low, which is really unusual. I mean, given that the market was so strong today, you would think, I would think that volatility would be, down here somewhere based on today's market action. But it actually didn't even take out last week's low. So I thought that was, I think that's kind of foreshadowing some information for us. In general, the market's not going to go much higher once you start getting the volatility down in this area. So, and I've got this line here around 15 as the midline of this meaty channel here. And certainly these lows here, you wouldn't expect to see much below these lows right in here. So, sometimes we don't think about going to look at volatility, but sometimes volatility can give you a clue to what's going on in the market. Think of it as like an internal measure, like what's going on behind price and behind order flow and volume and all these kinds of things. The ECB was in the news this week. The ECB cut interest rates. They're going to do their version of QE. And then they have negative interest rates for banks that want to hold reserves. I think these are going to prove to be just colossal mistakes. But you can see in our country, the short-term 13-week Treasury yield continues to climb, which tells me that our Fed is not going to be lowering rates anytime soon. I don't have such a chart for the ECB. If somebody knows what that symbol is, they can send it to me and we'll bring it up here. But I don't know what it is, so I don't know how to show you what. If you recall, I used this very chart to say here on the program that the Fed was going to raise rates, and the reason I said that is because rates were trading in this area that week before the Fed announced its rate hike. And of course, it pulled back, and look where it pulled back. This is what's so interesting about technical analysis. You know, it ran up, and look where it pulled back, right to this line I had drawn on here. I mean, I haven't moved this line. We can see, I mean, this is when I drew the line back here, because I took extend off, and you can see back here when I drew it. But isn't it interesting how it broke out and pulled right back to that line before it continued higher? And that's what's interesting about technical analysis. I mean, I wasn't even very precise when I put this line down. I looked at the price. I looked at 10 years worth of data, and I just kind of put a line down right here. I mean, I looked at these prices right here, this covey of prices, and I extended a line across. That was the extent of my analysis. I mean, it just was not that I bet I didn't spend 10 minutes looking at this chart, maybe 5 minutes looking at this chart and then drawing that line. So it just goes to show you don't have to be an expert at this. You just need to let your eyes kind of fall on the chart, and you can pick these areas of resistance and support as well. This is not rocket science. Let's see. I think that's all we want to look at there, because I spent so much time earlier. This is the US dollar, or some people call it the Dixie Index, the DX. And you can see we've got a fairly complicated looking, very choppy action here in the dollar. And, you know, we're going to see some movement in the dollar into this resistance zone, and then we should see a fairly good pullback. So, you know, I mean, we might go past this resistance zone. These are just zones, and there's nothing magic about them. And we could, you know, go up into this area. And I think I looked at these before. If you go way back and look at 20 years, you can kind of eyeball some, like you can see this little zone right here. What I did is I took a resistance area off of this zone from way back in 2002, and then this zone here is really off of this previous peak here. So really, this zone, near term, we should see the market stop. We should see the market ultimately stop here first, probably pull back, but then we could see the market, the dollar market, come all the way up to here. Of course, the euro would be doing just the opposite. The euro is going to be going down, and the euro is in a complex pattern too, a triangle type pattern, and we can look at the euro. Let me pull this open, and let's look at the euro US dollar. So you can see here the euro's in a triangle. We've kind of got this ABC, 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 AB, and then we should have a C down here. So this is going to look something like, you know, this, and then this, like that. I'm drawing it pretty fast here, but then this is, whoops, But then from here, you're going to see this go down, okay, and make new lows. So that's pretty much how the market moves. And you can see it here. Boom, boom, boom. Boom, boom, boom. Boom, boom, boom. Boom, boom, boom. Boom, 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 boom. Okay, so, and then we should see the euro, and we'll put a box or a support area below these lows right in here. We'll likely see the euro at least in this area here and potentially even lower than that area. So it's going to be exciting. It's really going to, these policymakers really get crazy and start doing crazy. I mean, there's some really crazy stuff going on in these central banks. China's central bank is doing things like their banks are basically insolvent. So, and they're insolvent because they loaned money to companies that can't pay off their loans. So the government is encouraging the banks to do a debt for equity swap. So let's say I'm XYZ company and I have $100 billion in debt. The Chinese central bank is telling the banks, which are also owned by the Chinese government, and these aren't independent companies. So they're going to the Chinese banks and they're saying, hey, forgive XYZ's debt and demand, 40% equity in the company in exchange. Well, obviously this is just going to, incite more bad behavior. The problem is when it's everybody's money, it's nobody's money. And that's one of the things that China hasn't quite figured out yet about capitalism. Capitalism only really works if it's your money at risk. Everybody individually has got money at risk. If it's everybody's money in a big pool and we're all sharing the risk, then it's really nobody's money. It's called the tragedy of the commons, and you should look it up. It's the cornerstone of the concept is private property, and it's key to why our free enterprise system really works well. Of course, it hasn't been working well in the last 20 years, primarily because government's been interfering with it. But anyway, we're going to see some colossal, crazy things happen in these countries over the next 10 years, and it's not going to be pretty. I mean, it's going to be bad. It's going to wreak havoc on these financial markets. So it's one of the reasons I started this YouTube channel, and not that I'm the only guy that knows about any of this stuff. I mean, there's a lot of people that know about it, but the reality is there's a lot of misinformation, and I mainly wanted to do this for my friends and family. So and to the extent they want to share it, that's fine with me. So here's gold, and we saw this long bull run up into the 1900 area on gold. And for the last several years, we've been pulling back in gold. And now, I had this kind of double trend line deal here. And if you recall, we started really talking about gold potentially looking good, really kind of all throughout this little cluster. Well, actually, I kind of got stung here because initially I tried to buy some gold here and it pulled back, and anyway, made a small loss. But then right in here for the last, several months, I've been talking about anywhere in here around this 1050 area would be a great place to buy gold or silver. And you can see that that's panned out pretty well. Now, gold's likely to move up into this area, and then what? Well, we're gonna have a pullback. Okay, the markets don't go straight up or straight down, but after we get into this area, we're likely to have some sort of pretty decent pullback, something along those lines. Okay, and then we're gonna take back off to the upside again. Okay, so if you miss this, I wouldn't chase it because you're going to be underwater soon enough if you if you buy here. But you could look for gold to move back. Maybe this is a little deep here. It may not move back that far. But you could look for gold to move back somewhere between this low here and maybe the midpoint of this candle right here. So let me draw a box just to kind of lay it out for you, like between here and here. So what is that? That's 1190 back to 1140. So if gold pulls back into that area, you might buy. You might wait till it turns, to buy. Now, just as a caveat, my feeling is that longer term gold is coming all the way back to here, and this is off of this low here, which is around 682. So I'm talking about gold ultimately coming all the way back to between 682 and as low as this area here around 561. But I've also talked about some of the issues with waiting until then. It's going to be very difficult to make money mining gold at those prices, and you could have significant mine closures. You could have significant bankruptcies of mining companies, and it's going to take some time for those companies to be bought out of bankruptcy and new companies to come in and take over the mining processes and whatnot. And during that time, gold could be going down, and yet there's no gold to buy. So just, of course, trading, it's not going to hurt you at all. If you just want to buy the GLD or something and trade gold, that's fine. But if you actually physically want to own it, it could be very difficult to wait until this time to actually buy it. So I don't really know. I mean, nobody knows the future. But it seems logical to me that if there's no money in mining gold, or if you've got too much debt and you can't pay it because the product you make is mined gold, then there might be a bankruptcy in your future, and therefore mining might be difficult. So just take that for what it's worth. Silver's got a little bit deeper pullback and has also broken out. It just hasn't really caught up with gold yet, but it will. Once silver gets moving, it really moves and moves fast. So wouldn't worry too much about silver not catching up. If you just focus on gold and try to time your purchases around what gold is doing, you'll be fine on your silver purchase. Let's look at oil. Here's this big pullback. So oil and gold have a similar pullback, but oil is way ahead of gold. I mean, gold. So you'll see a similar run up in gold to around that 1550 area or so, just like we said. So right now, if you want to look at a UR here, just an example, if this chart wasn't oil, it was gold, you're like right in here. Okay, so that means we got a pullback, we got a run up, and then we got a big pullback. So, just be patient if you're buying gold and silver. Let's look at the US dollar, JPY. I think this is a great currency to follow, especially as active as Japan has been. It's kind of stair-stepping down, but it looks like it's in for a pretty good rally, and it could rally as high as this area right in here, which is, like I said, significant. So if you're interested in the US dollar, Japanese yen, maybe look for the market to make a move into that area. All right, let's switch over to NinjaTrader and just take a look at the DAX. It's quite a bit brighter, isn't it? This trend line is not correct. because it's old. I haven't moved it. But you can see that, well, what you can see is that that's not going to cooperate. So let me draw a new one from the top of here to the top of that one right there. So you might see the DAX rise as high as this area here and then potentially roll over. What we're looking for here is a move down into this DP area off the lows, off the previous low, and then of course once we hit that DP area, we'll get a rally. So most likely all these markets are going to be moving together, but there's no way to know for sure. You just have to keep watching them. Oil, there's a lot of talk about oil bottoming this week. I don't know if it has or not. Somebody knows maybe, but it's not me. So what I do see is that we're just now at a point where it's kind of breaking out of this trend line. So, what's likely to happen is maybe it goes a little higher next week. You can see this previous area right here. A lot of times these end up being resistance. So, maybe it goes up a little higher and then it pulls back to the line. Maybe not that severely, but pulls back to the line like so, and then proceeds to meander its way up into this area. Now, what is that area? Because that's an important thing to know. I mean, oil's going to be going for a while. So, but I'm guessing, probably in this 59 to 65 area is where oil's going to go before it pulls back and rolls over and ultimately makes a lower low below this low. So we can put a DP there. And I think that's what you're likely to see in oil. The National Administration on Energy, or whatever they are, the IAEA, or whatever they're called, they're saying that oil's potentially bottom. I don't think so. If you look at a really long-term chart of oil, and I can't do it here, I've got to go back over here. You can see we had this move up. It's clearly impulsive, and we got this big move down, and I think we're likely to take out this low here and potentially move all the way back to this low here. So what are we looking at there? So, back in, what was that, 98, 99? The end of 98, beginning of 99, the low was at $10.65 a barrel. So I think you're at least going to go to this $15 area, but you do have the potential to go all the way down here to just under $10 a barrel, $9.50 or something like that. Okay, so just keep that in mind. But near term, when I say near term, I really mean over the next several months, you should see oil make its way up here into this low 60 area and maybe bounce around a little bit there and then eventually roll over and make some new lows. This is the FTSE. You can see I've got kind of an area here, but what you also see about the FTSE is, you got this downtrend line, which looks like potentially we've broken. So maybe what happens, it's already started kind of pulling back. Maybe it pulls back a little further into this area and then rallies a little bit and pulls back again. and then starts making its way up into this DP area. I don't know. That's not as likely to me, given where the U.S. market is at this time. I think it's likely that whenever this gets through doing what it's doing, chopping around here, it'll probably roll over and just go lower from here. So, but I don't follow the FTSE that closely, and I don't know really, just don't really have a good feel for the companies that make up that index. So take that for what it's worth, or take it with a grain of salt, as the commercial shows. But anyway, there's some interesting things. The Chinese have a saying, "May you live in interesting times," and I think we are living in interesting times. And I think, the government is going to be doing more and more things to undermine the value of our money, our savings, our liberty. You got this huge conflict with Apple, where they're trying to get Apple to, write software or put in hardware that disengages the automatic lock on your phone, and people are pushing back on that. And, I think people perceive that, we're not as free as we were 20 years ago, and the government is doing more and more all the time, taking more and more money, really they're less effective, but it doesn't stop them from taking money and devaluing our currency, and, with their slush funds and I heard the other day Hillary Clinton's campaign. Now, she takes money from donors, right? So people have given her money to run as a candidate, and she's taking some of that money and pays herself $250,000 a year as an employee of her own campaign. So, it's just, and they got this whole Clinton Foundation. there's just so much corruption, and and Bastiat, I don't know if any of you know who Frederick Bastiat was. He was a political philosopher that lived in the mid-19th century, and he wrote a book in 1850 called The Law. And basically what he said is that the purpose of the law is to protect life and liberty, and that if the purpose of the law is extended beyond that purpose, then you have one of two scenarios. You have either the few plunder the many, or everybody plunders everybody. And I think we're fast approaching the everybody plunders everybody scenario. People are clamoring for things from the government. They want more health care. They want more pension. They want more salary. They want minimum wage. They want their college paid for. They just want all this stuff. And I guess what they've forgotten is that the government gets its money from us. So essentially what's happening is everybody's wanting to live at the expense of everybody else. And to me, that sounds like everybody plunders everybody. Anyway, if you're interested in reading that book, it's really short. It's only 75 pages. And even if you just read the forward in it by Tom DiLorenzo, is excellent. But it's called The Law by Frederick Bastiat. And if you go to Mises.org and type in The Law in the search, you can get it for free. You can listen to it in audio. You can download it in PDF and read it in iBooks on your iPad. There's just some incredible classic works on that site, and would definitely encourage you to visit it. All right, well, I guess that's it this week. We've got maybe 2 more weeks at the most of this, and then we should see this trend run out of steam and start rolling over to the downside. Is there a possibility that we could go out and make a new high? Sure. Anything's possible. The market can do anything, but I think what you're more likely to see at this point is, maybe that, and then one of these with a tail on it. Whoops. Like so. And then we'll start seeing candles that look like this. And like I said, they get, as this picks up steam, they'll get longer and longer, and the panic will start setting in. But this gap right here, I think, is very critical. We're probably going to close that gap. So it's at 2,044. 2,044 will satisfy that gap. As you can see, that's roughly 22 points higher than we are right now. So look for, maybe a 10 or 15 point gain on Monday, maybe a flat open to a small gap open on Tuesday, a run up, and then a sell off, and then maybe some of this. So, all right, everybody, make good decisions. Don't let the market scare you. You can always get back in, but don't give your capital to the market. Don't let the market have your money. Okay? All right, everybody, thanks a lot for coming in and viewing this week's video. If you have any questions or comments, just comment in the comment section, and I'd be happy to respond or talk about anything that people in the group here want to talk about. But until next time, next week, you guys have a great week. And if you're on spring break, be safe. If you're going somewhere, you're traveling, be safe on the road. The number of terrorists that have killed Americans since 2001, since 9/11, is only about 80. There's only been about 80 murders of terrorists. Terrorists have only murdered about 80 Americans, but between 30 and 35,000 people a year die in car crashes. So if you're driving somewhere on vacation for spring break, be very, very careful. And that way you'll be able to come in next week and we'll talk again. All right, everybody, take care. Bye-bye.